Hey everyone, welcome to Decelerator. I'm your host, Rob Kennedy, and I'm not quite back into podcasting yet, but I thought it would be a worthwhile conversation. A friend of mine, Ryan Henry, who invests in early stage companies, went down to demo day at Y Combinator a couple of weeks ago. He typically invests in those companies, but did he invest this time or not? Only listening will tell you. And we also had a chat about what sovereignty meant because of Fable. I know it's a 2 weeks ago thing, which is basically a year ago, but because Fable was cut off from everywhere, what does that mean? And how should we think about it as entrepreneurs and investors and people in the ecosystem? What do we do? The chat I had with Ryan was on both topics, so I hope you enjoy. All right. Well, we're back from a hiatus. I don't know what the hiatus was, but it was a hiatus. And thank you, Ryan Henry from Sand Hill North. Do you want to give a one-liner? Because we've got 37 back episodes you can watch about Ryan's background if you want to.
Sure. My name is Ryan Henry. I run Sand Hill North, which is the venture arm of a single family office based here in Toronto.
Awesome. So if you've watched any of my old shows in the past, this would seem like an interview, but it's not. This is a conversation. And let's talk about what's going on, at least what's on our minds as we go through the ever-changing world we live in. It is 1,000,000 degrees when we record this, just after Canada Day on the 2nd of July. I think we need to anchor things now because by the time something comes out, nobody knows what's going to happen from one day to the next, right, Ryan? Is that how you feel too?
Every week is different.
Every week. It is 2026.
It is currently 2026.
It is currently the middle of the day on the 2nd. So who knows what's going to happen at the end of the day. But one of the reasons why I wanted to start with you, Ryan, and start off with this conversation on the topic that is salient to you, because you just went down to Y Combinator's demo day in the spring last week, 2 weeks ago.
2 weeks
Doesn't
ago.
matter. No? 2 weeks ago. Oh yeah, these companies are gone now.
Again, a world of
they've sold and merged and consolidated. But I thought, like, as an investor who has invested many times over the years, and it is sort of your North Star to a certain extent of the kinds of companies you're looking for. Hot take. What was your hot take? We'll go into some numbers about the batch, but like hot take for those who are like, I wasn't there, what happened?
I'll give two hot takes.
Okay.
One is a little more relevant to Sand Hill North. We didn't end up investing in any YC companies this batch, which is pretty abnormal for us.
Yes.
And then, so related to why, I think there were lots of great companies, and we'll dive into that. But this batch in particular feels like all of the companies were really just trying to rush for traction, revenue dollars specifically, and getting the highest revenue, which you'd think if you're an investor, you're like, well, that sounds great. But I think within the context of like what's happening within venture and within like what we as early stage investors would be looking for a venture scale company, the dollars is not the thing the only thing that matters. And so if you prioritize that over everything else, then you can build a great short-term business, but I don't know if it's venture scale.
Yeah, okay. We're going to unpack that in just a second. And the second, what was the second?
Or did you say the two we didn't invest, so I guess is the hot take.
Okay.
And then the companies were just after revenue.
Okay, so let's unpack that a little bit more. So, sure. From at least my reading of the news subsequently, and I know TechCrunch does a rundown every batch, two companies got $175 million. One, Nine Mothers, apparently is looking at $200 million off of a $1.6 million contract they signed.
Good for them.
And they think it'll be $35 million, they think. So before we get into some of the content of what they're doing, or maybe it's inextricably linked, obviously it's AI, agents, all the things. But what the fuck? I mean, this is an early stage accelerator. That sounds like Series B checks.
So that's a good point, because I think the context is maybe less specifically like what's going on with YC. Why are they so crazy? And maybe like I'll bring up a step. We talk about the Y Combinator companies in batches really as maybe a microcosm of what's happening kind of within VC, or at least a microcosm of what's happening within San Francisco, Silicon Valley VC versus maybe the rest of the world. But Carta publishes data quarterly. I think if we look back to their Q1 data, specifically on seed stage valuations, I think it was, I think the median might have been like somewhat flat, somewhat up over the past couple of years, but the 75th and 95th and 99th percentile was like straight up exponential.
Mm-hmm.
And so if you're talking about venture and you're talking about let's just say the 99th percentile, just kind of keep the number simple. The I think it was the 95th percentile was somewhere around 175 million valuation for Q1 2026. So it's probably gone up for Q2. But again, let's just say that was the 99. So let's say 1% of the companies get that. Well, if a YC batch is close to 200 companies, you'd expect then 2 companies to be at that valuation.
Mm-hmm.
And I kind of think that's what we see. So kind of regardless of like, could anyone justify that for an early stage company? If you're taking the batch of YC companies, and YC companies are probably at the let's say at least average, but maybe well above average in terms of valuations that they raise at on demo day, you should probably see a couple of companies that are like out of the park exceptional founders, out of the park exceptional growth, revenue, traction, everything. And so can they get those valuations? Obviously. Are they justified? I mean, is any venture valuation justified?
Yeah, it just feels like we're not going to talk about it in this episode, but like the Startup Genome folks released their, ecosystem, like innovation index or whatever it's called. Actually, last year at Web Summit, I interviewed JF Gauthier on that report. And it's all the money. Like, I think it's like $2-3 trillion in value being created, half of 50% of it, which is in America, and 95 of the 50% is the Valley, like San Francisco and the Bay Area. And it seems that these valuations are very speculative, but it seems a little, I don't want to say bubbly. It just seems like it's setting up these companies for impossible. Like
I always feel like it's easy to talk about like why that's bad or why it doesn't work, and yet there will always be these exceptional, like again, the most exceptional of the exceptional companies that continue to just completely defy expectations. Like to me, that is kind of what I mean, at least on one dimension. Like that is kind of what venture scale, when we talk about venture versus just like a good tech company or the average tech company, like we are looking for those exceptional companies. I think it is highlighting the trend that is happening in venture right now that everywhere in the world is feeling, in that capital, even at the earliest stages, is concentrating into the best of the best companies. If again, I don't want to pull out the details, but more and more capital on a quarterly basis is being driven into venture companies, but fewer and fewer deals. So those companies are raising more and more at higher and higher valuations, but only the best of the best of the best of the best are actually closing those deals.
From my notes, like there's a Rebel fund. They invest. They're XYC investing in YC. They have a little modeling thing that they've created, and they said it is the strongest batch in YC history compared to the prior batch. And it's the highest number ever recorded. 7% of 190 companies, 14 companies hit $1 million ARR by demo day.
The revenue numbers were wonderful, I would say.
That's so. Again, is this are they just getting better at selecting? Because back in the early days of Decelerator Town, what I learned, I helped run and build some of the early ones in like 2011 kids, and I remember that the first cohort was like, we found promising people, and there was like the one I helped with the most was something called Idea Boost, which was with the Canadian Film Center. So trying to take like the principles of startups and apply them to entertainment technology companies. And one of them was ASAP Science, which still exists. But then there's a whole bunch of companies that didn't. And what I learned is like, hey, if you want to look successful as an accelerator, you know what you do? you pick the people that are successful on the way in, and they're going to be successful on the way out. Because is your sausage maker that great? And YC special? I have no, and back in the day, Techstars was special and 500 startups was special. YC is obviously special, but is this just like a selection bias? You're just selecting the better companies. Are there really that many better companies? Is this, because this is also a paradigm shift in terms of, and we'll get to.
I think that's probably the relevant conversation, because like whether we know that YC is just better at choosing, like will take years to play out. Like it may look like they're better at choosing right now. It may look like they are kind of choosing the hottest trend, the hottest founders, prescient of what's going to happen in the next 4 years. But like 5 years from now, 10 years from now, when these companies actually start to exit and like for meaningful exits, and not just small acquisition exits, that's how we'll know whether they were right or not. And that's I don't want to have necessarily that conversation. And even Rebel Fund's model that they kind of talk about, like I'm glad they try to quantify it, but that's still their lens of how they look at those companies. And the point I had made not that long ago was that this batch was very focused on revenue. So if Rebel's model is cares at all about revenue, I mean, yeah, this batch is going to look the best. I think that's a fair assessment.
Yeah, but you just, I guess you have to ask the question to yourself. It's like everyone is the best, better than the last, and you're like, is that true? Is that truly true, or is it better selection, or is it something's wrong in the state of Denmark? There's something going on that again, I think because this isn't like 2015 SaaS territory. This is still like we're figuring out.
Maybe it's worth kind of talking about like how they choose or how VCs choose and what is happening now. As much as I said, like fewer deals are happening, but more dollars are going into them. I mean, that's kind of like what's happening within the capital flows within the industry. But slightly aside, like obviously what's happening is like what has happened with AI. What is different about these companies versus SaaS companies 5 years ago or 10 years ago? It definitely felt like within venture, we had gotten to this point where we knew what the successful SaaS company formula looked like.
Exactly. Yeah.
And everything was like smooth sailing. Like if you reached this revenue number or you had this level of traction, like you could spreadsheet it and be like, this is a successful venture scale SaaS company. And really in the last year in particular, but a couple of years, with all of the changes in AI, I don't think it's so clear anymore. And so YC obviously has their approach to how they think they're going to be successful. They still run a fund, they're not just an accelerator. They invest in all of these companies. So they are still running a venture scale fund. They obviously have the power law on their side of having 200-ish companies per batch. So close to 800 a year. But what's happening on the product and business model and company side of things, it's not clear what the scale, the SaaS scale looks like. How long should you be pouring money into growth? What do good unit economics look like? How do you price that? What are they going to be when they exit? What is the expected cash flow based on their margins? Like there were formulas for that. Obviously like fuzzy formulas, but formulas for that. Now, I'd say there's a bunch of different little things happening. On the one hand, deep tech is more popular now, and that could be because investors are saying, well, the only thing that the AI models aren't going to just completely replace are the physical things, and so I'll invest in any hard tech company or deep tech company, any robotics company. Sure. It could also be that the difficulty of those companies has been dramatically reduced by using AI, even though the cost to drive some of those is still quite high. But even within like the SaaS world, or what pure software companies look like today, there's now pure software companies that are trying to do exactly what SaaS companies were doing 5 years ago, but at an AI native scale. So moving super quickly, trying to close revenue and validate their unit economics today versus a year from now, and just move as quickly as possible. There are also then pure software companies that are heavily skewing towards the services side of things. And Sarah Tavel from Benchmark wrote a wonderful article, super smart, years ago, 2023, somewhere in 2023, talking about selling work, not the software. And that was all about actually now funding the services side of it to say,
Yeah.
well, if we can start doing this work and selling the work rather than selling the software to do this work, I mean, there's a whole, and not to replace humans, but like starting to chip away at some of the revenues that were going to human labor now can be considered software revenue. So there are a few different business models starting to emerge, and different VCs are going to be interested in some of those. The valuations of each of those is going to be different. I think what is consistent across all of those, though, is VCs are still choosing based on the founders. At every stage, this is true. This is obviously true of YC. YC does nothing except choose what they consider the best of the best founder, whether it's pedigree or multi-time founder or previous YC founders or strong references from other YC founders, whatever they consider. But the thing they care about is the best founders that they can find. And frankly, at the earliest stages, when you invest in the best founders that you can find, you're going to be successful because they are amazing.
Yeah, I mean that's the argument with a lot of those funds, right? Like with A16Z or Sequoia, it's not necessarily that they are better choosers. In fact, I believe their returns can show you that they don't return necessarily the way that they should be necessarily returning, given the risk. Based on data, I'm not making this up. I can find the thing and link to the tweet or link to the data, but they get the best deal flow. If you get to choose from the best of the best, you're going to have good outcomes. It's just not, yeah. So I guess what surprised me is one thing I've been thinking, and I'm not sure how you think about this, is the version of this reminds me, the smells of, I'm that old, was the internet boom and bust, not the mobile one, or not even SaaS. Or crypto, I guess. It was the internet boom and bust, where it was like, what is this? What do we do with it? And how do we figure out, like, again, it was like Amazon was books, and then it was store, and then it was AWS. These things, notwithstanding the boom and bust, took time to figure out, what is this for? How do I use it? And the difference this time around is, to me, it's not, I'm reading a audiobook. Is that a thing? Listening to an audiobook? I heard recommended called Muskism, which is basically looking at sort of the sort of tech elite and that sort of worldview using Elon Musk as sort of like the lens. And it was interesting because the point that they were making, the exploitable thing that he's got is he's figured out how to take a public resource, a government public resource, and then turn it into a company. So on the shoulders of public created things, the space agency, the desire to build an electric ecosystem or a car ecosystem, he's been able to build businesses subsidized by those government checks. And what is interesting about this AI stuff, unlike the internet, which was designed to keep the American government running when there was a war, this is like, private. The infrastructure, this is infrastructure. The infrastructure is private infrastructure. We're all renting on private infrastructure. So that's messed up. It's just a really materially different thing. The cost isn't zero. The floor of the cost is not zero. And depending on which model you use and the day, and we'll talk about that in the next segment, like, these are material costs that change. It's almost like, they're open enough, unlike, say, building on Zynga on Facebook, where if Facebook shut you down, you're screwed. But it's not 100% open. Like, if they choose to IPO and they choose to double the costs, your business may or may not make sense. So I'm wondering,
to your point, that definitely feels a little more like internet era-y, where the new software players like Amazon in the early days, it wasn't clear what they would become. But certainly if you had invested in Amazon when they were selling books, you would have done well long term.
Yes.
Because you invest in the best founders. Whereas I think what was happening at that time was what was playing out in the public markets was obviously funding the underlying semiconductor and build out infrastructure side of it.
Yeah.
And the software side was too early and really only started to IPO in late, and then the crash happened. Similar, I think what you're seeing something very similar happening right now, in the sense that all of the infrastructure players, whether you're talking about the new neo clouds like Cerebras or there's a long tail of these companies.
Yes,
so
there's a lot of
anyone basically like just buying NVIDIA chips, putting them together and kind of selling the capacity, they're all doing extremely well right now.
Yes.
And even Facebook just the other day, when they said, well, look, we probably have excess compute, we're just going to sell that compute, their stock increases by like $60 billion or something like that.
It's like their IPO is Anthropic buying a bunch of
exactly, like all they're doing is just selling their excess compute. So those companies are obviously right now doing extremely well. The business models, even though it's not necessarily clear like who's buying it and what those contracts look like, those business models are working within the public realm. What's not working within the public realm are the new types of AI native software companies that are still really early in the VC days. We aren't sure what those look like. We don't necessarily know what those business models look like. How do they scale? Where does the cash come? Where do the problems really come? And this maybe just to
and what's the use case, right? They don't know the use case yet. We think that's a use case, and they're betting on owning that entire chunk. Sorry to interrupt.
And that's exactly my point. When it came to my comment about the YC batch and why we didn't invest, again, not because they're all great. Many of them are great founders. There are probably a large number of wonderful companies, but given the valuation, I didn't care about the revenues because I don't think that those revenues today are representative of the trend of revenues where they're going to be 5 years from now. I think it's very spiky. I think it's easy, and not trying to trivialize it, but I think it's easy to get to $1 million of ARR today by selling some sort of like AI middleware. I'm going to help a bunch of companies make agents or spin up agents, because that is a in-demand problem today. It's easy to spin something like that up that gets people interested, but that's not a valuable company 10 years from now, because somebody is going to win that entire middleware space, or some few number of companies will. And is it worth trying to choose the winner within the mass amount of noise right now? I don't. That's not a bet I want to take.
Well, last question about money, and then I want to talk about tech. The last question about money is, I think the thing that gets me is it feels like these things are so overvalued that the entrepreneurs are kind of fucked. I mean, I understand that they're trying to do the winner take all mindset here, and they're like, we will own that. That's how they're approaching it. But
I think I don't disagree with you, but maybe I'll provide the optimistic VC side of things and why we invest in some of these companies at even these crazy valuations. If we were pegged to the SaaS era 5 years ago, then yes, the valuations look insane. For a founder who's raising at $100 million seed round today, could they possibly raise an up round at their A? Like, the bar for that must be extraordinarily high. No one's going to do it. Maybe a couple. Obviously, the exceptions will do it. But back in 2020, so pre-COVID, like just like the last days before COVID, what we considered a VC growth fund was like $1 billion fund.
Right.
And today, VC growth funds are like tens of billions of dollars. Like they're private capital, and are they VC? Who knows, or who really cares? But the scale is just very different. And so there's so much money being put into these companies that as long as they continue along some sort of trend, and whatever trend is kind of up to whoever is leading those rounds at the time. But as long as that trend continues, then the valuations, at least for these VC scale, exceptional companies, will continue to go up. What I'm interested in as it relates to that is not necessarily like, what is the new version of SaaS? What is the new spreadsheet version of SaaS within the AI world? But I'm looking for new business models that could not have been done in the pre-AI. Mm-hmm. Where one of my favorite companies out of not this current batch, but I think it was the last batch, it was a company called Terranox, a bunch of Canadian founders who had some uranium mining background, decided to not just build software to predict where mining companies could find uranium and then sell the software, but they're like, well, look, it's our software, it's our AI, it's our expertise. We think that we can do it. We're going to raise enough money to go and buy a bunch of mining rights to some land that our AI model has said there's uranium, that we could find uranium. And then we're going to drill. And if we find uranium, we don't want to be a mining company. We still want to be a software company. But if we find uranium, we'll just sell that mine. And so whereas they could have sold that software for, let's just say, a $10 million license in a year, if they find uranium, which I'll come back to in a sec, if they find uranium, they can sell that mine for $700 million. So sure, they have zero revenue between now and when they find uranium, but the business model scale is the risks that you're underwriting on investment are fundamentally different than can they build software and can they sell software. This is more like the very old venture, like very traditional venture capital, where it's like I'm the king of Spain sending a fleet of ships across the ocean to find spices or
Go
gold.
find India. Go
And
find
like,
India.
did they find it? Like,
America.
these are crazy risks that, as long as you understand how the company and founders are trying to de-risk that, you can underwrite that, you can figure out what that might be worth. And the size and scale of those companies, very different versus 5 years ago.
Yeah. Also deep tech sounding, right? It's
I'm a
AI
software investor, so it's like just enough software in there that
but that, I mean, it feels pretty moaty, right? Like I can't start that.
Yeah, exactly.
Or should I? And so that's a great segue into the second half of this part of the conversation. Very curious. What I've read, and tell me if this came up for me. It's like, it seemed to me that there's like infrastructure for agents. So like all the things that go around agents, the care and feeding of agents, do they have a sandbox? Will they, logs and all this other stuff that makes sure that they're good actors, they won't murder anyone. They're capable. We saw that with OpenClaw, and now they're like, like don't delete my production database. And is that a trend that you saw?
Yeah, both at YC and not YC, like probably half of the companies I see today are basically this. And whether it's agents or whether it's AI infrastructure or middleware, or we help companies spin up, it's all related to helping companies get up and running with AI, or building something with AI, or managing their AI in some way. And again, there will be massive companies built in that layer, but there are so many companies starting, and again, very quickly scaling to $1 or $2 million of revenue. And so anyone looking at those companies that only has a lens from 5 years ago, any investor who's looking at these companies would be like, wow, winner right here, like winner right here. Like these winners just keep coming to me. Like I'm just obviously going to keep throwing money at them. But that bar to push through the noise is extremely high. And the bar to do anything other than this tiny little wedge is also super high. And really the winner is probably going to be the company that can spin up those agents, manage the control of those agents, make sure that they're well tested, manage the security of the, like they're not just going to do one wedge, they're going to do everything. And again, there will be winners. Some investors who are taking the risks to invest in these companies will do quite well. But it's so hard to find the winners. So unless you're willing to invest in 50 or 100 of these companies specifically within that wedge, it doesn't feel like a good risk worth taking on the investment side. But again, that's just the way I think of it.
Especially because they're taking venture style money, therefore it's a binary win-lose, as opposed to because I was asked to moderate a panel at the National Angel Capital Organization, so NACO, a Canadian advocacy. They try to advocate for early stage investors and sort of organize them in some way, shape, or form to galvanize it. And the panel had a bunch of investors, venture style investors on the venture capitalists. And one of them was like, not against having a services arm to the point that you made earlier. And I think part of the idea would, to my mind, that's messed up. I actually ended the panel on that comment because I said to the angels, I'm like, you heard it here, folks. First, folks, invest in services companies. But it feels like it's a combination of somewhat like Modi. My general thesis about everything is trust is the only thing that matters now, because everything except for uranium mine discovery is kind of a commodity. So therefore, the thing that makes you sticky and not insta switch is the person who's helping you figure this stuff out, or the team helping you figure this stuff. Do you think they know what they're talking about, and are they adapting to your specific problems? Otherwise, it's just yank one out and shove another agent in. So I think there's a learning curve, but also like a moat sort of created with that thing that makes you a little more sticky. Does that resonate or no?
Yep, yeah, very much so. That is what's happening, and again, those companies that are,
I'm only asking for compliments. No, if you disagree with me,
the companies that are finding the $1 million or $2 million of revenue very quickly are the ones that, to your point, are able to move quickly, kind of find where there is enough value, and whether that's recurring SaaS revenue or whether that's services revenue. Like, I don't know. Everyone's business model is up in the air today. You'd really have to dive into it. And whether that's just like the tokens that they're reselling and really their profit or their revenue is actually only like whatever the small upsell sliver is. Like, I couldn't tell you. There's so much happening within that space. I think it really depends on the company. And this is, as an investor, I guess, like a reminder to all investors, like that's where you need to dive in. Like, you can still be investing in great founders, but the business models are fundamentally different now. And you need to like trace it all the way down to that revenue and then ask yourself, like, is this revenue actually meaningful revenue today versus 5 years from now? Is it on the same trajectory, or is this just like one-time temporary services revenue that just doesn't matter?
Then just to wrap up, the narrative in the world is SaaS is dead. RaaS, results as a service, that was what it was a few months ago. It might have changed, which is, you're not charging a monthly fee, you're charging based on outcomes. The example that's most salient to me was actually a Canadian founder. The company was called OpenPhone, kind of a VoIP phone box, so you can do customer success on the web kind of thing. And then they pivoted to become Quo. They have lots of ads, and it's basically agentic CSMs effectively. And rather than charging you $50 a month for a telephone, I can charge you $2,000 because I'm replacing your employee, and they're having the same outcome. So so if you're in this weird business model land where you're like, I don't know what the business model is going to be in 2 years, how does an investor even do that?
So yeah, that's a fair question. This is kind of like why why investing is the hard thing. Like, if there was an obvious answer to that, like I could think the computer would do it.
Yeah.
But really, I guess my answer to that is, like, when you are talking to that founder, the question that I always have is, like, does this founder actually understand something that many other founders don't, or that I don't? Like, do they understand this space or this trend, or do they have that belief that it's going here? So you can underwrite any of those. Like, if I really believe this founder, even if they're wrong, that like this is the direction that the tech goes, but if they're like somewhat directionally correct, and I trust that founder can find their way, like I can invest in that founder and the belief that founder has in that direction. I could invest in a founder that has a super deep academic background in a particular area that I think is a bit of a moat around there. You're always looking for that moat, or what is that difference, and I think that's the job of being the investor. It's like, find that thing that aligns with you, find that thing that you can justify, that you believe in, and that you've built a strategy of investing around. Every single investor is going to be different about that. I'm super opinionated in one way.
Like you said, is this model durable? Like, I understand that again, I just wrote an article like about a week ago, be around for luck, engineer your serendipity. So you just need to be around long enough for the serendipity to hit. And so I get it. But as an investor, you're like, this is a SaaS style thing, or I know this is not, like especially with these AI business models, you don't know what they are. Where you're investing in infrastructure in this particular case, because that's where we're at, and that's good because that's where software companies. No,
I guess I would just push back a little bit to say, like, just because you invest in a company doesn't imply that you invest in that space, or that's why you underwrote the investment. Right? Like, that may be part of what this company is doing.
Sure.
But my thesis might be strictly around, I invest in super charismatic founders because I believe that they can shape the world around them.
Sure. Those things are obviously rare, but I guess more about how do you model what that is? Or maybe you just don't care because you're like, I'm going to pretend it's a SaaS company and hold my nose until we figure out.
I think if you try to model it, I think, again, if you go back to the SaaS world 5 years ago and you try to put this on a spreadsheet, and I'm not saying don't do your due diligence as an investor and try to model it out or try to think about it, but to me, it's less the model it out and build yourself a 3, 5, and 10 year cash flow prediction. And instead, like, as an investor, what is your thesis? What is your strategy? Why are you investing in this person? Why are you evaluating this person in this company? Does it fit within that? And then, as part of the diligence for that, again, have you at least thought about, like, what does the world look like? Why do we think that this company within that thesis is still going to work? There's not you're investing in a lot of your, like, certainly opinion, the founder's opinion, what research you can do. But the thing that is consistent right now is that all of these business models are changing. Some from the SaaS era will survive. maybe some of the numbers that were this, the lever moves over here and becomes this, and that's fine. But until the dust settles, it's like you kind of have to diligence it all. You have to ask yourself all of these questions, be like, well, I got to go with what I believe and what my gut says here, or what at least I told my LPs I was going to invest in, and like that's where I'm focused. And you've got to just believe in your strategy and be consistent.
That makes sense. All right. So now we're going to pivot, pardon the pun, to the other topic of conversation, not unrelated, Fable and Mythos. So for those who are nerdy and pay attention or don't pay attention, Claude released, they talked about Mythos, which was the secret thing that could accidentally find exploits in every single piece of software in the world. They released that to a few companies so that they could plug the holes. And then they released a version of that had what's the word? The desire, ability, need to kind of they crippled the ability for those exploits to happen in Fable. Basically, they launched it. The American government said, "Oh, it's too dangerous," quote unquote, or whatever. You can't let non-Americans use it. And Anthropic was like, "We don't know what that means because we have non-Americans on our team." So they just killed it. It now came back yesterday as of the recording of this show. And it was cool for when I did try it for a short period of time. Did you ever use it for anything before it went away?
Yeah, I used it the day it came out.
And
I mean, it was good. I guess like I wasn't necessarily using it to find super obscure holes, security holes that I could exploit. I mean, I do a lot in the. I personally invest a lot in the crypto space, so it would have been interesting to be like, can I like break any of these contracts? But no, I don't think I put it through its paces well enough to be like, oh yeah, it is actually that good. Because at least from my perspective, I was like, yeah, it's smart. Is it meaningfully better than any other?
It definitely eats your money faster.
That was true. That was definitely true.
I think they're giving like, you can get 50% of your usage this week for that's all you, and we won't cut you off. I'm like, I'm going to ask it one question. But so here's the interesting thing I wanted to go back and forth with you on. So we've seen this in different shapes and forms, but now it's the most explicit, which is, hey, the US government can say, we don't want something. I mean, they already picked a fight with Anthropic a few months ago when they wouldn't let the Pentagon allow the AI to pull triggers or do whatever they wanted it to do. So there was already on sort of rough footing, but we're in a place where like, if you're an entrepreneur and you're building on this infrastructure, it may or may not be there. And I'm curious to your thoughts about like, I mean, what is going on right now is, Canada just released its AI for all policy, investing some amount of money into infrastructure. The UK just stood up a £500 million sovereign AI fund in April to be an AI maker, not taker. My thought on this is like, well, if the Americans are building $1 trillion data centers and the Chinese are doing the same thing, if you're not one of those two countries, then
should you be trying to compete?
What does that even mean? And what does sovereign even mean? Like, should we be spinning up? Like, what does that even mean? How do you think about this? Because we can't be dependent on them, but also we're probably not going to beat them at their own game. I'm not trying to be mean to Cohere, but
yeah. And I mean, I guess I'll also try not to wade into the political side of it. I guess I'll give my bias, my framing, and that at least then I set my own, set the context for it. So as investors, we invest a lot into US companies. I would love to invest into more Canadian companies, but also a lot of the founders that I invest in Canada end up moving to the US anyway. So a relevant question there is like, how much do I care about that sovereignty? How much do I care about, or how much am I worried about any Canadian investment that I do not getting access to these models? And I'll stay a little bit away from the what would I use personally, or what do I think the government should do? Because I'm not in government. I really try to stay away from I'll have opinions about everything. I'm a VC, of course. Sure. But on the investor side, it does matter where that risk is. I do think there is some risk that overnight the model that you were using within your software gets changed or gets taken away, like we saw with Mythos. It luckily wasn't kind of out long enough for companies to have like pivoted to building this into their workflow and then disappearing. And so I'm kind of aware of that risk, but I'm not that worried about the risk, mainly because then when I think about more of the game theory side of like, should the US be doing this? Like they have a close competitor in the Chinese models. So like what the US would have to be worried about right now is balancing the security side of their own infrastructure and their own banking and economic infrastructure versus like how much can we let China catch up? At least the Chinese models catch up, because for the most part, the Chinese have consistently been, let's say, 6 to 9 months behind the state of the art model. So again, if we've got Mythos today, by the end of the year, or certainly early next year, we'll have a Mythos capable open weight model coming out of China. And when those open weight models come out, frankly, anyone can use them. I mean, the US could argue that they put restrictions around US based data centers from running those. But again, if I'm just a company, I can just like retrain, repackage that model to make it not even look like those models, but perform equally as well. Now I have my own Ryan's fantastic model, and the US isn't going to shut me down if I'm a US company or a Canadian company, or at least stop me from running that open weight model. So again, like those open weight models are coming. There's no way to slow those down. So the more they slow down the state of the art models from continuing to push that state of the art ahead and maintain that 6-month gap, they just risk more and more and more letting those Chinese models catch up and potentially even surpassing. I don't think that's a risk that the US is willing to take. And so because of that, even if we end up with short-term snafus, like with what is happening right now in the approval process of Mythos and GPT-5.6 coming out, I think it's short term, and I think we will very quickly move beyond that once there is that risk of China beating the US.
Well, also, I'm happy I don't really care about the politics at the moment either. I don't want to wade into that at the moment. I think, to your point, like, I guess, yes, Fable is, let's pretend there's a Fable or a GPT 4.6 Chinese model that will show up in 6 months or a year. Who cares? I'm wondering if it even matters at this point. I mean,
to who? Sorry, the countries, the companies.
The company. Well, let's.
Me as a consumer.
Yeah, like to companies, I'm like, it gets better, okay, but what if you had like, if you used a GLM today, as it is today, and is not as good as Fable, okay, can you do a lot of the things that you want to do already with the technology that already exists, that's open source, open weights, whatever, and people are doing their own. Like a friend of mine in Scotland pointed me to Rio de Janeiro has their own open weights model that apparently is quite good. Like we're just there. It's like just I can buy a PC and spin up my own PC.
So it really depends on the use case.
Yes.
Right. So if I'll just take coding as a big use case and kind of generic use case. If we jump back 9 months ago, so let's say September of last year, it was still true that if you were a developer trying to use these models, in many cases they were kind of dumb. Like you still have to give it enough context, but like even if you did everything right, like sometimes it was just bad, sometimes it hallucinated, sometimes the code quality was meh. So you really still had to babysit it a little bit. The state of the art models very much changed in December, near the end of December, when those models came out, when the newest models came out, and basically overnight. And again, I'm trying to generalize and trivialize, so I'm sorry, developers, if you disagree with me, but pretty much overnight, coding was solved. And now if you are a best of the best coder, you're not writing code. You're probably not even babysitting that code. You're babysitting the AI, you're babysitting the context, you're building workflows and pipelines, and that's where your effort is going. Because that problem got solved when those models got good enough. So if we take another use case, whether it's sales or marketing or whatever, I don't think the best of the best models like Mythos have solved everything. And so depending on what that dimension is, like it might be in that place, again, like coding was 9 months ago, where it's like, it's wonderful, it's really good, it can really help accelerate us as individual humans doing that work, but it can't completely solve that work. I think any inflection point or any model that does one of those for any given dimension, like, is super important that it gets out into the community as fast as possible. Because we can iterate, we can learn, we can automate, we can move fast.
Totally. Yeah. No, it just seems to me that over time it will diminish these models. Or knowledge work was solved a year ago, right? Like it is better if you use the better models and you get better essays, no comment, or better podcasts. But like that, it is incrementally better. I mean, and you're right. All of the private capital in the entire universe was focused on destroying the craft of software development over the last 12 months. Once that box is checked, I'm sure it'll be like radiology or some other thing that, sure. But it also feels like these specialized models are being, pooped out that do one thing very, 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 very well. And so I guess going back to the sovereignty question, a lot of countries were spooked by this behavior and were like, we need to do a thing. Do you think that it makes sense if you don't have unlimited capital to build your own? There's building your own II, and then there's hosting your own AI, which are not the same thing, obviously.
So back to the point that you asked around, like, what even is the sovereignty side of it? Are we simply talking about like the actual data that is generated or stored? Are we talking about the AI model itself and where it's trained, or what's in its pre-training or even post-training? Are we talking about the infrastructure to run the training or inference side of this? Because certainly we now know that the infrastructure to run this, like if you want to set up a gigawatt compute data center today, whatever the number is, somewhere between 50 and $100 billion. Well, no one in Canada, including the government, is going to pay to set up even one of those. And I use that as kind of a bar because that is Anthropic building let's say, the state of the art today. It took basically their entire gigawatt compute cluster to do it. So in order to reach that, let's say you just have to have a gigawatt. So unless you're willing to spend $50 billion to build that, plus the time it takes to build it, plus then have the ability to train that, like you just can't even build a state-of-the-art and state-of-the-art today AI model, let alone a state-of-the-art AI model 6 months from now. So there's the infrastructure side that is infinite money to set it up.
Yeah.
There's the can you even compute at the AI core foundation model layer. Then there's the data sovereignty or software sovereignty side of it. Like, sure, maybe it's worth making it so some data, financial health data, for example, stays within your country or can't get can't get released in some way, can't be used against you in some way, I guess. Like, this is not really a space that I'm personally concerned about, but again, government has different concerns than I do as an individual investor. But I just don't think it's reasonable from a sovereignty perspective to try to keep up with the state-of-the-art model, or to be like, oh, like the US shut down Mythos, we need our own version of Mythos. Like, how are we going to do that? Okay, well, do you have hundreds of billions of dollars and a lot of time right now to do it? Versus, like, if I'm advising the government, which I'm not, but if I was from an investment standpoint, I'd be like, okay, but Canada, what are you really good at that maybe feeds into what they need? So that, again, like, we can work together. This world where now all the countries have to be angry at each other and can't cooperate is kind of dumb. Which is why I don't really care about this US-Canadian border that much. I definitely care, like, obviously I live in Canada, I love Canada, I want Canada to succeed. I'm just not worried that Canada is not going to be able to succeed. So I think there's a ton of stuff. I mentioned mining as a good example. Like, I think there's a ton of stuff that we as Canada are incredibly good at and have a ton of natural resources that, like, we still have a ton of value to provide the rest of the world. Let's just focus on that.
Yeah. I think it's just when the plug is pulled on us, and I agree with you. There's a stack.
Yeah, sure. What's the risk? I agree.
And what do we do? And how does one think about that as a country, and also as an entrepreneur, or like, and how are you betting on this stuff? I think, like, it does. There was one other layer that I thought was super interesting. I can't recall the source of this. I think I know who it was, but there was the sovereignty is also an interesting question from who owns the company point of view. So I think the apocryphal story I was heard, it's not apocryphal, it was citable, but I can't. I'm not a journalist, but I can't remember who told me this, but they were credible. It was I believe it was Microsoft was hosting something in France. The company it was a French company hosting their data in France on a Microsoft stack. and I believe it was the FBI that was like, we need that data. And even though it was a French company on a French hosted Microsoft server, Microsoft is an American company. And so,
and this is where I'm glad that somebody has to think about those things. And I'm glad that the government is.
I just think
I probably, as an investor, even of that French company or Microsoft at the time, I should probably be aware of it.
But just it's a layer. When people say sovereignty, they think it is physically planted on my soil, and once it is physically planted on my soil, it's safe. And it's not always so clear that.
And when we wrote a lot of those data sovereignty laws, regulations within Canada, the compute infrastructure, the way you built up data centers that were mostly a little bit of compute on top of a ton of storage, like fine, those laws made perfect sense. But now if you talk about sovereignty and if that data doesn't live within a hard drive anymore on our soil, and instead it's embedded in the pre-training of a foundational model, where does that model live? Who owns that model? Like, it's certainly not going to be us. We just don't have the dollars or compute capacity to live at that frontier.
It was
so I'm not saying don't try. I'm not saying don't be aware of it. Yeah. Don't try to solve this problem. I just don't think the easy answer of spin up a $50 billion gigawatt data center and train your own frontier model. It's certainly not the answer. Like, there's a reason Cohere decided not to run that race, and Mistral as well. Like, they were two, whether they were close to leaders or not, they were two companies within that race that were like, no, that like we don't have the resources dollar-wise or time to do that. It doesn't make sense. And so I don't think a government can step in today and say, like, do it anyway.
Right. It was just to close out. There was I caught yesterday on I think it was NBC or something, but it was on X, and it was an interview with Alex Karp, who's always an interesting guy to watch be interviewed because you never know what he's going to do. And it was a 20-minute conversation where he was basically like pushing Palantir and saying, we believe that you work with us, and then those models back there, that's what we're utilizing those, but we're the ones that are in between. So you trust us because we're not training on that data, and we can choose those models, which models we feel like using. So it was basically saying, it was a strange way of making the case because he's kind of nutty, and went off, and it was an entertaining interview to watch just because he's kind of nutty. But I think that was the point that he was making. And I think that's Cohere's argument as well, and a bunch of these companies, which is like, we don't care about your data. Your data is your data. Our job is to make sure you can do stuff with it. Exactly. Using AI, whatever that means.
and so related, what are the privacy rules? What are the sovereignty rules around that? Like, again, I'm glad somebody's thinking about that. I do not have a super nuanced take on it, other than it's just not my concern. Where I invest, how I invest, it's just not a concern that I have. Fair. But again, I'm glad somebody is thinking about it.
And it's an intractable problem. Well, Ryan, thank you so much for having the conversation with me today. For people to check out Sandhill North, where do they go on the current version of the internet?
You can always go to sandhillnorth.com or shn.vc. You can always email me at ryan@shn.vc, and it will be an AI that reads your email, but it'll make its way to me.
Depending on the version we're allowed to use that day.
Correct.
Thanks for taking the time, Ryan. And if any of you have hot takes to share with us, please do. And thanks for coming on the show. See you next week, everyone.
Thank you.